Escalating conflict between the United States and Iran has turned the vital Strait of Hormuz into a global energy flashpoint. Both The Guardian and CBC report that, while mediators seek a ceasefire, the strategic strait has remained closed to shipping. Doubts over an immediate resolution grew after an unidentified projectile reportedly struck a cargo vessel off the coast of Oman near the passage. This ongoing disruption in a crucial maritime choke point immediately sent shockwaves through energy markets, driving up crude prices and raising severe concerns about a renewed global inflation wave as key oil supply routes face direct operational threats. As energy prices surged from the conflict, integrated energy majors reaped massive financial returns. The BBC reports that BP recorded a profit of roughly $5.7 billion, marking its highest earnings since 2022. Meanwhile, coverage from The Guardian highlights that profits for major oil firms more than doubled, reaching a combined total of about $93 billion during this war and climate crisis. While higher crude prices directly boosted corporate balances, environmental groups have openly accused these energy giants of profiteering from geopolitical instability, sparking intense political backlash over windfall gains during widespread economic strain. Market sentiment has wavered due to mixed signals regarding diplomacy. According to The Guardian, American and Qatari officials reported progress on securing a ceasefire and reopening the Strait of Hormuz, echoing claims that a deal was close. This initial optimism briefly pushed oil prices down by roughly 2%. However, CBC highlights a sharper contrast. Tehran pushed back against assertions that official talks were underway, while fresh attacks near the strait quickly erased price relief. This friction demonstrates how tentative diplomatic messaging creates volatile market swings as traders struggle to assess the true trajectory of the conflict. While energy shockwaves threaten global consumer prices, financial markets have displayed complex reactions to shifting headline risks. The Guardian notes that when crude prices temporarily eased, the United States stock market rallied to record highs. The S&P 500 shot up by roughly 1.8%, topping its prior record, while the Dow Jones Industrial Average added about 907 points, or 1.7%. These record highs reflect how Wall Street remains acutely sensitive to energy price fluctuations, balancing corporate earnings growth against the underlying threat that persistent energy inflation could derail economic stability. What news coverage collectively underplays is the strategic paradox facing energy giants during geopolitical crises. While reports highlight short-term earnings surges and brief price dips, they gloss over long-term strategic realignments within the companies themselves. For instance, BP Chief Executive Meg O'Neill urged local authorities to prioritize United Kingdom oil and gas resources for jobs and tax revenues, even as the company prepares to sell its North Sea business after 60 years in the basin. This contradiction reveals how energy majors are trimming traditional assets while benefiting from high prices, leaving domestic markets vulnerable to future supply shocks.